The safest stocks to invest in right now. The stock market is vital to the economy's health. For a nation and its residents to succeed, the economy must be stable. Unfortunately, everyone is encouraged to start to time the market, whether it's the stock market, the real estate market, or any other market. It's human behavior to want to outsmart others. And this is just the start of our uphill fight against the urge to time the market. When we reflect on events in the past and think they should have been foreseeable, the next reasonable option is to start to forecast what will happen in the future. However, there will always be analytical or market cues to purchase or trade, making assumptions far more difficult than hindsight bias would suggest. The current crash in the stock market. The stock market plummeted the day after the Federal Reserve raised interest rates for the first time in over 40 years, ostensibly to combat rising inflation in the United States. The Federal Open Market Committee, or FOMC, increased the funds rate by 75 basis points in November 1994. The Fed funds rate was raised to a range of 1.5% to 1.75% due to the significant move. The S&P 500 is currently down 2.8%, the Dow Jones Industrial Average is down about 2.0%, and the Nasdaq Composite is down roughly 3.7% as of midday. Bond rates soared after the ruling, though they're still well below their all-time highs. The benchmark 10-year rate is at 3.34%, while the 2-year rate is at 3.18%. Predictions for a larger Fed rate hike had skyrocketed ahead of yesterday's announcement. The general expectation heading into June would be that the Fed would deliver another 50 basis point rate rise, consistent with the Fed Chair Powell's remarks at March meeting. Then, in May, the Consumer Price Index, or CPI report, shattered any prospect of inflation slowing. The figures show that inflation surprisingly surged in May, climbing 8.6% year-on-year, the highest level since 1981. The April CPI figure was lower than expected, raising expectations that price hikes were slowing. The market expectations had almost overnight begun pricing in a 75 basis point rise as the most probable, and the Fed did not hold back. While observers hailed the larger move as evidence that the Fed is taking inflation seriously, the true concern is that the Reserve Bank has allowed the situation to collapse. The tragic error of last year was not moving rates sooner to create more breathing space for future meetings, says Brad Conger, the deputy CIO of Hertel Callaghan & Co. The FOMC is now boxed into responding reflexively to inflation data. The terminal Fed funds remains the same at 3.80%. During the post-decision media briefing, Powell said the economy is well placed to withstand tighter policy. Markets, on the other hand, are less specific. If inflation continues to surprise to the upside, they are likely to tighten more than they currently think is appropriate, says Bill Adams, chief economist for the commercial bank. On the other hand, if the economy's current slowdown turns into an outright recession, potentially including a decline in house prices, the Fed could hike less than expected or start cutting interest rates earlier than they expect. Stock markets are vulnerable to manic depression swings, bouncing from excessive optimism to unreasonable pessimism in days or weeks. That's most likely what's been driving the market in the previous 24 hours. Markets soared in the aftermath of the judgment on Wednesday, finishing the day with a substantial gain. The sale, however, came back with a vengeance. Markets are factoring in an 88.5% possibility of another 75 basis point rate hike at the next Federal Open Market Committee conference on July 26th to 27th, putting the revenue target for federal funds between 2.25% and 2.5%. Safe stocks to invest in right now. Growth stocks. Growth stocks are Ferraris in the field of stock investment. It guarantees quite much development and, with it, a lot of investment rewards. Growth stocks are mostly linked with technology firms, but they don't need to be. They usually reinvest all of their earnings into the company, thus dividends are rarely paid out, at least not until their growth slows down. Value stocks. Many firms' valuations have been strained as the market has risen dramatically in recent years. When this occurs, several investors flip to value stocks to be more conservative while having a chance to achieve significant returns. If the market supports value stocks once more, propelling their valuations up, value stocks could go up quicker than non-value stocks. The attraction of value stocks is that they allow you to earn above average profits while assuming less risk. In addition, many value stocks offer dividends so that you can get a little more money there. Stock funds. If you don't want to devote the time and energy to researching individual stocks, a stock fund, whether it's an ETF or a mutual fund, can be a good alternative. If you purchase a highly diversified fund, such as an S&P 500 index fund or a Nasdaq 100 index fund, you'll get a mix of high growth and low growth firms. However, if you own a few specific equities, you'll have a more diversified and safer portfolio. Viewpoint of experts. According to experts, here are 4 primary reasons you should never attempt to time the market as a trader. 4. The price of tonight's dip could still be more than today's. Markets fluctuate and the estate does not always appreciate. However, it makes no difference if you're expecting the next property market downturn and planning to buy when prices are lower, because you never know when the peak or the ensuing low will occur. The argument is that today could be the perfect day to buy a rental home on a platform like Roofstock. Prices may never be that low ever. Stocks are all the same way. The nadir of the next stock market correlation may still be greater than today's prices. You can't possibly know, and no quantity of technical information can provide answers. 3. Downturns and corrections are unpredictable, even for analysts. Armchair investors sometimes believe they can forecast what the market does when even the greatest professionals in the industry can't. This is a tribute to man-nature's vanity. Take a 2018 analysis by the International Monetary Fund, which looked at 153 downturns from 1992 to 2014 in 63 nations. According to the study, only 5 of the 153 downturns were forecast by analysts by April the previous year. Even when they correctly forecast a future recession, they frequently misjudge its magnitude. Investment banks, meanwhile, use some of the brainiest and best paid financial analysts to forecast market movements. They possess access to vast economic information that no one else has. Unfortunately, they're still bad at forecasting market ups and downs. You can't accurately predict the economy when experienced economists and financial experts can't. 2. The stock exchange isn't reasonable. Still believe there's a secret key out there that will allow you to break the code if you correctly integrate different research techniques? The stock market consists of figures, yet it does not simply move on those numbers, at least not entirely. The stock market is built on the actions of human investors. Man investors who are passionate, greedy, or afraid respond to the day's headlines by sending the market soaring or plummeting downhill. Employ all the algorithms, reasoning, and math you want, but market fluctuations will always be unpredictable and irrational due to the human aspect. Any automated trading systems do not require stock market volatility. Instead, they worsen it by initiating institutional buying or sales based on the upward or downward motion. 1. Frequent trading costs you money in commissions and taxes. All those men who attempt to time the market by jumping in and out whenever they feel they see a peak or a low, only one continuous victor emerges from their alleged ingenuity: brokerage firms. Many people charge for each buy and sell order, and they chuckle all the way to their bank vaults. For this reason, day trading is so difficult to earn money. You have to be correct considerably more frequently than not to pay the expenses of numerous trades. Taxes are yet another expense of frequent trades. Earnings for investments held for less than a year are taxed as normal income by the IRS rather than at the reduced capital gains rate. You can lower your capital gains taxes and your ordinary income taxes by adopting the systematic, longer-term investing technique. That's all there is for today. Leave a comment with your thoughts on which are the safest stocks we can invest in right now. Also, make sure to leave a like and subscribe to the channel if you enjoyed the video, and click the notification bell to never miss out on videos. Stay tuned.